For years, the golden rule of investing has been simple. Buy the S&P 500, buy index funds, set it and forget it. Well, in 2026, I'm doing the opposite. I'm actively selling down my broad market index funds, and if you're still blindly following that advice, your safe play might just be the riskiest bet you're making. I know that sounds crazy, but the market has fundamentally changed. In this video, I am going to lay out the data, why the Magnificent Seven are actually a ticking time bomb, the dollar cost averaging trap of a highly concentrated market, and my three-phase strategy for exiting index funds and reallocating into more resilient assets for the new decade. This isn't about panic, it's about adapting. Let's dive in. Let's be blunt, the S&P 500 isn't truly diversified anymore. They make up an unprecedented percentage of the entire index. This isn't diversification, it's concentration disguised as diversification. When these giants stumble, the entire index feels it. Think back to the dot-com bubble. When a handful of tech stocks crashed, the whole market went with it. We're seeing similar parallels today with AI hype driving valuations to levels that, frankly, scare me. Your diversified portfolio might be more vulnerable than you think. Everyone preaches dollar cost averaging, DCA, and it's a fantastic strategy in a healthy, broad market. But when the market is dominated by a few potentially overvalued giants, DCA becomes a trap. You're essentially dollar cost averaging into a decreasing probability of real diversified growth. You're buying more of the same concentrated risk, hoping the music doesn't stop. The returns from the S&P 500 over the next decade are unlikely to match the previous one, precisely because of this concentration and the pull forward of AI gains. We need to be more surgical. So if I'm selling index funds, what am I doing instead? This isn't about market timing, it's about repositioning for structural changes. Don't sell everything at once. Reallocate 10 to 20% into ultra-short-term treasuries or high-yield cash equivalents. This is your dry powder. It stabilizes your portfolio and gives you an emotional distance. 2. Think healthcare, consumer staples, utilities. These are boring, but they offer consistent dividends and tend to be less correlated to the Magnificent Seven. I'm also looking at quality mid-cap and small-cap value funds that have been completely ignored. 3. Think industrial tech, overlooked SaaS, or niche infrastructure plays. This is where you find the next generation of leaders, not just the past ones. Selling index funds goes against decades of advice, but in 2026, blindly following old rules is dangerous. The market has changed, the concentration risk is real, the Magnificent Seven won't carry us forever, and DCA into that kind of risk isn't prudent. This isn't about predicting a crash, it's about building a more resilient, diversified portfolio for the new economic reality. What are your thoughts? Are you still all in on broad index funds, or are you starting to feel that shift too? Let me know in the comments below. If you want to stay ahead of these macro shifts, make sure you hit that subscribe button. And if you're ready to dive deeper into custom portfolio strategies, check out my free 2026 portfolio audit checklist linked in the description.